I'm Jen Bailey with the Unity Group of Legacy Mutual Mortgage, and let's talk a little bit about what happened with mortgage rates in May. So if you look at the chart behind me, being low on the chart means higher rates, and being high on the chart means lower rates. Green is good for mortgage rates, and red is bad. So if you look at the chart, in the middle of May, mortgage rates got pretty high, and then they eased quite a bit. Kind of very volatile all the way for the past few months since we've been dealing with the Iran conflict, but overall they've improved quite a bit off the highs that we have seen over the past couple of months. So let's talk a little bit about what went on in May. So mortgage rates spent most of May moving higher after starting the month in the low sixes. They finished closer to about the mid sixes. That's roughly where we're at right now. The primary driver was renewed inflation concerns, the rising energy prices, the geopolitical tensions, stronger than expected economic data like good jobs reports showing that our employment is doing well in the country, which is great for our economy, not great for mortgage rates, so it pushed rates upward. Many market participants who expected rates to steadily decline in 2026 were reminded that mortgage rates remain highly sensitive to inflation and bond market movements. Now, despite these higher rates, the housing market still showed signs of resilience. Pending home sales increased for several consecutive months as homebuyers took advantage of the temporary dips in the rates during March and April. Existing home sales in May rose to their highest level since December, indicating that buyers are still entering the market when opportunities arise. Inventory continues to improve compared to the ultra tight conditions that we had like in 2021, 2022, 2023. Buyers have more options, they have more negotiating power, they have greater success obtaining seller concessions and rate buy downs than they have had before. Affordability does remain challenging, but today's market is a far more balanced market than it was during the pandemic. San Antonio in particular remains one of the more balanced housing markets in Texas. Inventories hovering around 5 to 6 months of supply, depending on the area you're looking in. This gives buyers considerably more leverage than they've had in years. Homes are taking longer to sell, but prices have remained relatively stable. Now, sellers who price correctly are moving their properties quickly, but overpriced listings are sitting longer and typically require price reductions and concessions to get it sold. What to keep in mind and watch out for going forward, the biggest factor with mortgage rates remains to be inflation. If inflation cools over the summer, then rates could gradually move lower. If it remains elevated, they could stay in the mid sixes, maybe even hit 7. We will see. The outlook, basically best case scenario, by the end of the year, high 5s. Most likely low to mid 6s. Worst case scenario, we might revisit 7%. Most likely, most economists are expecting we'll probably remain in the mid 6s, maybe low 6s. But that is your market update for May.